channel where we are going to talk about all things personal finance. Today we are going to talk about term insurance. Specifically, we are going to talk about how long we should take term insurance and whether we should do limited payments or regular payments, right? So these are the two things we are going to talk about. It does get a little more complicated when you pull in some other factors, but we're going to keep it at a high level and just try to understand why people recommend you only take uh, pure term insurance till you retire, and you only do regular payments and you don't do limited payments, right? As everybody knows, term insurance only pays in the if the insured person passes away, and it does not pay anything if you outlive the maturity period of the insurance, right? So if you take your insurance till the age of 55 and you live past 55, you will not make any returns on it. But this insurance is not for returns. It is to protect yourself and your loved ones once you are gone, right? Your liability should be covered, and that's the goal of the insurance, right? So it is not to make money, it is to cover your liabilities. And we will talk about how we calculate these liabilities and how we should go about planning for our insurance. This is at a high level, but it should give you enough information. Okay, so let's dive into this. Let's assume there is someone called Sachin, and he is in the age range of 35, and he's looking to retire in the next 20-25 years, and he's thinking about insurance right now, right? He's just taken a home loan, or he's about to take a home loan, and he's deciding how much insurance he should take so that his family is taken care of in case he passes away, right? So let's say we are in the year 2020, and Sachin sits down and sees what are his main liabilities, what are the things that will need to be taken care of if he's not around, and he lists down three things. He says child's marriage, retirement for himself and his family, and home loan. These are the things that need to be taken care of if he falls dead tomorrow. So right now it seems his child's marriage is going to cost him 1 lakh rupees. We saw in our previous video on present value, future value, time value of money that this will keep going up as time passes by. Let's say it's at 8% inflation in marriages, so it will cost 1 lakh rupees this year, 1 lakh 8,000 next year, 1 lakh 16,000 the year after that, and so on and so forth. He's decided his child's going to get married in the next 7 years, so these are the numbers that come out for that. Retirement, Sachin's decided after sitting down and doing some calculations, 50 lakh rupees is enough for him. He can put that in a simple investment plan, and he can make enough on a regular basis to take care of all his liabilities, like all his costs such as um, food and electricity and things like that, right? So 50 lakhs is what it's going to need today. Obviously it's going to be more going forward, so 53 lakhs next year, 56 the year after, and so on and so forth, and it goes into a few crores as we move ahead. Home loan, right? So he's just taken the home loan, he's going to make EMI payments. Let's assume he's going to be able to make his EMI payments, and this home loan amount is actually going to go down the longer he lives, right? So this amount is 50 lakhs right now, next year is going to be 48 lakhs, the year after is going to be under 46 lakhs, and this is going to drop down to zero in the year 2035 because he's taken a 15-year loan, right? So that's the plan. He's going to have zero home loan by the time it's 2035, and he's not going to have to make any more payments. So his liabilities add up. When we add up these three lines, his liabilities add up to about 1.1 crore this year, and they go up to 1.3, 1.7, and they keep going up, and you can see that over here, right? So his liabilities are constantly going up, mainly because of retirement, and they reach about 2 crores at some point in 2044. Okay, so those are his liabilities. Now obviously he's going to be making some savings along the way as well, right? So let's say he makes initial saving this year, he's going to make 5 lakh rupees. As he goes along, his plan is to make 10% more every year, right? So he's going to save 5 lakhs, then he's going to save 5.5 lakhs, then he's going to save 6 lakhs. I'm not even talking about investments over here, right? He's just going to increase his savings rate as his salary goes up. That's what's going to happen over here. So that's all we are talking about. We are not doing any sort of investments over here. So his savings become 5 lakhs next year, 10.5 lakhs the year after, 16.5 lakhs the year after, and this goes up, right? This goes up to 2 crores and 4 crores as we go by. You can see that as the blue line in the graph. And then let's see how much insurance he needs. His insurance needs are going to be his liabilities minus his savings. So up front he's got no savings, so he's going to need insurance of 1.01 crores to cover all of his liabilities. And as we go along, you can see that his actual insurance needs keep going down rather than going up, right? Because he's saving more and more money, he's paying off his home loan, his child is getting married, so all of these things keep checking off, and he keeps making reducing the amount of insurance that is needed, and the insurance requirement actually drops off in the year 2033. At this point, all his liabilities are actually covered by his savings and by his home loan being paid off, and anything that he gets from the insurance company at this point as he passes away is a bonus, right? So he can stop paying his insurance if he wants in the year 2033. So as you can see, you only need insurance to a certain point in your life. After that point, your savings should ideally cover all your requirements from an insurance standpoint. This insurance is not an investment. It is it is a policy that will save your family in case of your untimely death. You should not be betting on your death. You should be betting that you will live past your retirement age and you will enjoy your retirement. And at that time, you will use your own money to enjoy your retirement, right? So that's why you should only take it till retirement. In retirement, you're not going to have any income. So even if you pass away, all of your money is going to actually come from your investments, and your family is going to be able to live off of that. So again, you don't need to replace yourself. Your replacement is zero at that point, right? So you don't need an insurance to replace yourself. So that's the reason for taking insurance till your retirement age. Now let's talk about why we should only do regular premiums and regular payments and not limited payments. So I'm going to go to the next tab here that I have here. Okay, so let's talk about limited versus regular uh, payments. Let's say we are going for the 1 crore insurance plan till the age of 70. Again, I don't recommend till the age of 70, but we are just going to do it uh, for example purposes over here. So let's say he's going till the age of 70 and he's got 4 options. He can pay for 5 years, he can pay for 10 years, he can pay for 25 years, and he can pay for 40 years. I have pulled the numbers from one of the leading insurance sites, and it says I need to pay 78,000 rupees if I'm going to do a 5-year plan, 40,000 for a 10-year plan, 21,800 for 25 years, and if I'm going to pay for 40 years, I'm going to have to do 18,048. Now on the website you will see they will show you a nice discount percentage that you will get if you do this plan, right? I'm only paying somewhere under 4 lakh rupees instead of the 7.21 lakhs I will actually pay if I do the regular payments, and I'm saving 46%. That sounds like a great deal, but we have to remember our time value of money video, right? So in the time value of money video we saw, money paid later is actually cheap when you're compared to money paid now, right? If I'm paying 18,000 today versus I'm paying 18,000 10 years from now, the 18,000 10 years from now is cheaper than the 18,000 today, right? So that's what we need to remember. These numbers look the same, but the value keeps on reducing. So let's say we go down to the bottom of this table and I've done some calculations, right? I've done present value calculations on these table payments. So let's suppose this person does not die and he lives past his 70 years payment that he has made. All his payments are done. Let's do the present value calculations. So if you do the simple present value calculation here, you will see that the limited payment is actually 3.5 lakh in present value terms, 3.1 lakh in is the 10-year, and so on and so forth. And you see the regular premium is actually cheaper, right? In the long term. This is against the total they are saying you are paying versus the present value of what you are paying. So you can see over here, you're actually not paying less when you do the 5-year limited payment, right? And in this example, we have not even taken anything like you investing the extra amount and getting money from mutual funds or anything. We are just doing a 6% inflation discount on the fact that the money you pay later is actually cheaper than the money you pay right now, right? It's a simple 6% return just based on inflation. If you had kept it in your bank account and you were just paying it out like that, that's how it would be. So obviously there are reasons why you might want a limited payment. You might be in a job where your income's going to dry up. Maybe you are in a lumpy kind of job where it's better to get it off your chest. Then it may make sense. But for most people with standard income streams, it does not make sense to pay limited premium, right? So run your own numbers, come to your own conclusions. There's a lot of blogs out there, there's a lot of videos out there which will discuss this, but I just wanted to show you this pretty quickly, and throw out one more consideration. Let's say the person actually dies at this point, right? After 11 years he dies, right? So if you consider you have already paid 4 lakh rupees on the 5-year plan, you have already paid 4 lakh rupees on the 10-year plan. But if you look at the 40-year plan, you've probably paid only anywhere close to 1.8 lakh rupees at that point, right? So in all the scenarios, you're going to get the 1 crore rupees, because that's guaranteed, because you've been making payments. So in fact you've paid less and you're getting the same amount back, right? So that's another way to think about it. You are paying only till the point you actually need it. If you outlive it, then obviously I showed you the present value, and if you die earlier, then anyway you're paid less money than you would in the limited premium, right? So those are the reasons I think you should go for limited. You should not go for limited premium. You should go for regular. Um, I hope this video has been helpful. I'm going to cover a few more topics on insurance later on, but wanted to get this off the chest because this keeps repeating on many forums, and I wanted to get this clarified. Hope you enjoyed it. Hope you learned something from it. If you did, please hit like, please hit subscribe, and provide your feedback so I can improve our videos.